afternoon. Today we're pleased to welcome back as a regular attendee CA&S to Unlock the Stock. This platform is created for retail investors so that they can connect with corporate management and to get to better understanding of them and to get to know their companies a bit better. Today we are joined by Duncan Lewis, the CEO, and Frans, the CFO of CA&S, who will take you through the company's presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. You can visit their website at lumiglobal.com to discover more about their various online AGM and investor presentation solutions. The Q&A session will be hosted by the Finance Ghost and Mark Tobin of Coffee Microcaps. Before we start, there are a few housekeeping notes. The company presentation will be followed by the Q&A. You can post your questions by typing them into the chat box, which is at the bottom of your screen. The event is being recorded and will be available on our YouTube channel soon. You will also see an email address when we begin the Q&A session. Please take note of it if you'd like to be added to CA&S's investor distribution list. I am now ready to hand you over to Duncan and Frans, who are going to take you through the presentation. So Duncan, if you could share from your side, please. And go ahead.
Thank you, Vanessa. Good afternoon, ladies and gentlemen. It gives me great pleasure to be back on Unlock the Stock platform to present our business and the results for the year ending December 2025. Before we discuss the results, I'd like to share with you a little about our business, what we do, and whom we service. Our business is to provide route-to-market solutions to brand owners, enabling them to access markets, shoppers, and consumers across 10 geographies and in many retail environments. We are privileged to represent manufacturers of the world's best-loved brands. We do this across multiple categories such as personal care, home care, snacking, grocery, beverages, and more. The average client has been with us for 19 years and some for as long as 5 decades. Our client is typically number 1 or number 2 in the category in which they compete and is focused on long-term brand building and building relationships with their shopper and consumer. We act as our clients' in-market execution team, taking responsibility for getting their products into stores and helping them succeed once they are there. We manage everything from retailer relationships and product listings to warehousing, delivery, shelf placement, promotions, and ongoing stock availability. Our teams work on the ground every day to ensure products are easy to find, well presented, always in stock, and positioned to sell, so our clients' brands perform at their best in every market we serve. This slide sets out a strategic foundation of the group. African FMCG markets are fragmented and operationally complex. Successfully scaling brands across the region requires deep in-country distribution capability, strong retailer relationships, and consistent warehousing and consistent execution across many channels. Without that, brand owners face higher costs, operational risk, and slow market entry. Over decades, CA&S has built that capability. Our businesses have deep local roots, including almost 40 years in Botswana, nearly 50 in Namibia, and over 5 decades in South Africa, supported by more than 400 years of collected operational experience across all our businesses. This has created meaningful barriers to entry through embedded retailer relationships, operational infrastructure, and trusted partnerships with more than 200 leading FMCG brands. Importantly, this operates as a multi-market execution platform. Infrastructure, systems, and client relationships are leveraged across markets, creating operational leverage as new brands, categories, and countries are added. Today, The platform spans 10 markets and services approximately 160,000 retail outlets. As scale and density increase, the platform compounds in value. At the same time, strong structural drivers such as population growth, retail formalization, and increased outsourcing of route-to-market solutions from brand owners continue to support the demand for our model. This slide, you'll see the 10 countries in which we operate. The light green is really our Southern African footprint, which is South Africa, Botswana, Namibia, Lesotho, Eswatini, Zimbabwe, and Zambia. In that territory, we service between 70 and 80 million consumers. If we look at the darker green, that is specifically Kenya, Uganda, and Tanzania, and we're servicing 230 million consumers potentially in that geography. If I talk a little bit about the financial results, you'll see revenue increased by 2.3% to 12.8 billion. Operating profit increased by 10% to 860 million. Headline earnings increased by 17.9% to 690 million. Headline earnings per share increased by 17.1%. Total dividend per share increased by 17.4%. And then lastly, net asset value per share increased by 14.9%. In Q1 of last year, we announced the transaction East Africa, where we bought a minority stake in Tradco, a business that had been run and started by David Mayena for over a decade. I'm pleased to say is that that geography grew over 24% in revenue for us last year. I think the important thing for us around this geography is it's an area of expansion for us. There's a demand for our services in that geography, and we think that we have a combination of positive GDP growth, rapid urbanization, a fast-growing modern trade, will all act as a catalyst for us to have accelerated growth in this geography. If I look back over the last 5 years, and I just talk about the results we've had an average compound average growth rate of 10% in terms of revenue, EBITDA average of 6.6%, return on invested capital just 19%, and then net debt to EBITDA ratio negative 0.2. But if one talks about return on invested capital, it came in at 21.2% for last year, well above our cost of capital, reflecting strong capital efficiency and real value creation. The EBITDA margin was 7.8%. This was supported by disciplined cost management and improved operational execution. Net debt to EBITDA is a negative 0.6 times, placing the group in a net cash position and giving us significant balance sheet flexibility. Together, this underpins our ability to both fund growth and return capital to shareholders, as reflected in the dividend increase of 17.4%. I think one talks about the key performance drivers. I think that a focus on operational execution. We execute brand strategies at the point of purchase, and we're very focused on making sure that we are efficient and operationally effective. I think that client-led geographic expansion remains a priority and our single biggest opportunity. And I think that ongoing investment in capability, whether it's internal systems, processes, technology, and our digitization journey. I'm going to hand over to Frans now to talk in more detail around the financial results. Thank you, Frans.
Good afternoon, and thank you for joining us. Going into detail, I prefer you guys go and study the financials. It's on our website, but in the time limit we have, I'll just briefly touch some of our financial results: income statement, balance sheet, working capital, and the cash flow. 2025 was a challenging year across many of our markets. Management's challenge was keeping products available for customers while dealing with higher costs and lower volumes in certain regions. Against this backdrop, CA&S Group delivered a steady and satisfactory financial outcome. Group revenue increased by 2.3% for the year. Growth was impacted by a softer performance from Botswana on last year. Notably, all major operations, including Botswana, remained profitable. Acquisitive growth was limited to 0.3% from our increased investment in 2024 on Mac Mobile from associate to a subsidiary. It should also be noted that the Kenya acquisition is accounted as an associate, and that number of their revenue is not included, although they have increased their revenue growth with 24% from the previous period, which is in line with our East Africa strategy. Total organic growth of 2% was made up of new client contribution 1.8%, mainly from new client sign-ups in our growing Lesotho operation. Price increases of 4.2%, broadly in line with inflation, although some of the commodity categories, such as rice, experienced price decreases. These positives were impacted by a 4% decline in volumes during the year. Operating efficiency resulted in a gross profit margin increasing to 16.1% from 15.4% in the prior period. Operating expenses were well controlled through efficiency initiatives across the group. Associates also contributed positively to the bottom line with the Tradco acquisition. As a result, EBITDA increased by 10.9% to 993 million rand. Profit after tax increased by 15.1% to 714 million. This increase was related to some tax changes in some of the countries, like Eswatini, that reduced the tax rate from 27% to 25%, a reduced dividend withholding tax charge due to funds transferred from reduced funds transferred from the regions, as well as a once-off 17 million rand prior year period adjustment relating to the employee incentive, tax incentive in South Africa, which was treated as a permanent difference in the tax returns, and we received the credit on that. Headline earnings increased to 17.9%, and that's a result of managing the margins and the cost discipline. CA&S Group had revenue growth in all our geographical regions, with only the Botswana region contracting with 3.8%. It seems like this slide is a little bit off. I'm not sure if you guys see the right slide there. There it comes up now. So, sorry. I just need to... Sorry about that. So you'll see that all our regions have revenue growth, except our Botswana region that contracted with 3.8%. Botswana is still making up 47% of our total revenue of the group. With the acquisition of the Tradco group and our option to increase it further with 20% to 55%, we should reduce our diversifications, our risk around the different regions with that region that will come up as a subsidiary if we execute our option. If I go to our balance sheet, the CA&S Group continues to maintain a strong balance sheet supported by a conservative capital structure and solid cash reserves, providing flexibility to support growth and manage future risks. Non-current assets have increased mainly due to two investments during the year. Firstly, the Logica operation was at full capacity and commenced construction of a new large-scale warehouse with an estimated projected cost of 300 million. 120 million was spent during the year. This excludes the land that was bought in 2024. Secondly, CA&S Group invested 108 million to acquire a 35% interest in Tradco as part of the group's East Africa expansion strategy. The increase in current assets was mainly driven by cash generated from operation, resulting in higher cash balances. These funds support dividend payments in line with our dividend policy and allow the group to fund acquisitions from internal resources. Total current assets amounted to 4.5 billion and made up of inventory 22%, trade and other receivables 42%, and cash 36%. Borrowings include a Botswana property mortgage of only 89 million, of which 52 million is non-current. This original borrowing was 316 million, and we have paid it off over the period, started to reduce it significantly over the period. Other non-current liabilities mainly relate to finance lease obligations. Current liabilities are largely trade and other payables, and 28% relate to short-term borrowings for the group. Return on equity for the year was 20.5%, which remains in line with the group's target return of more than 15%. Working capital remains a key operational focus. At year-end, net working capital days was 38, 1 day better than the previous year. Receivables remain in a healthy position with very, very low bad debt levels. Inventory averaged 34 days, with a focus on investing in key product lines for service level increases. Payables averaged 51 days, with early settlement discounts used where beneficial. We continue to invest in systems, processes to manage the working capital. Cash generated from operations for the year amounted to 923 million. Profit from operations 963 million, and a working capital outflow of 41 million. The net capex outflow of 177 million include 122 million related to the construction of a 25,000 square meter warehouse in Eswatini, which is expected to be completed by the end of this year. A 150 million mortgage facility was secured to fund the remainder of the project. Free cash flow generated for the year amounts to 456 million, supporting dividend payments and ongoing expansion plans. The purpose of this slide is just to show our shareholders that CA&S Group continue to create value for shareholders. The net margins have improved over time through operational efficiencies and organic and acquisitive growth. In closing, I would like to thank all our stakeholders across the CA&S Group for the commitment and continued contribution during the year. Thank you. I will now hand over to Duncan Lewis.
Thank you, Frans. I'm just going to discuss the territories in some greater detail. So, obviously, Frans spoke about the contracting revenue in Botswana, but, solid improvement in the quality of the earnings. I think that we saw a meaningful step up in profitability with EBIT and EBITDA up 13% and 13.1% respectively. We also strengthened cash generation through tighter working capital management, particularly inventory and receivables. I think operationally the business continues to benefit from network optimization and the integration of business distribution capabilities, which is improving cost to serve scalability. I think for us, Botswana remains a key territory. We still have very much an invest to grow mindset, and the focus of the team is to deliver for existing customers, to make sure that we grow market share over this period and remain dependable, reliable, and a safe pair of hands for both retailer and brand owner. If one talks about Eswatini, we got 6.4% revenue growth. You'll see that EBITDA, whilst still very, very significant at 167 million rand, contracted in terms of percentage over the previous year. I think that Frans alluded to it, is that, Eswatini is really important to us. We are bumping our heads in terms of capacity in that region. We moved into new facilities for our liquor distribution business, SMC. In Logico, we invested in ongoing capability, whether it was systems, processes, people, and capability. And we expect this territory to continue to contribute positively to the group. Frans mentioned that the facility will be finished at the end of this year. We'll only move in Q1. We don't want to disrupt Q4 trading, and that too, once we moved into the facility, will deliver efficiencies to this geography. If you take Namibia, 4.4% revenue growth, a significant increase in EBIT and EBITDA. I think that Namibia has been a tough geography for us if one reflects back on the last 3 or 4 years. So we're delighted with this improvement. The team have bedded down the TNC transaction. I think that we got the client base that we are happy with. I still think that we are under-indexed in this geography in terms of revenue and with margin. And I think that as we develop our new business pipeline, onboard new clients, this business will continue to grow and close the gap on our competitors in that marketplace. South Africa, delighted with the 10.2% revenue growth. I think that the EBIT and EBITDA results speak for themselves. I think that this team has done a sterling job of managing onboarding of new clients, managing their cost base, and really setting themselves up for future success. I think that South Africa for us remains an opportunity to grow. If one looks at the potential, we're a 2 billion business, 2 billion rand business in South Africa. But I think the opportunity is to expand that considerably as we roll out new services and offerings in this marketplace. If one talks about East Africa, I think that we spoke around the 24% revenue growth. You'll see that the slight contraction in margins, it's because we're expanding our distribution capability. In our view, the opportunity in this market is around formalizing that market, consolidating that market, and as we speak, we're moving into new facilities, rolling out our distribution capabilities, because the clients we serve are looking for a full service offering, and we believe that we are doing the right things to set ourselves up for long-term success. If you take the other geographies, Lesotho, Zimbabwe and Zambia, I think that getting nice revenue growth out of this geography. I think our Lesotho operations is hitting a sweet spot. We doubled the business last year in Lesotho. We expect the expansion to continue as we roll out new and existing clients and they grow market share there. In Zambia, not only do we have facilities in Lusaka, but we opened up facilities recently in the Copper Belt. We've onboarded new clients and we're expecting accelerated growth out of our Zambia operations. If one talks about the outlook, I think that we're just going to continue what we have already started, and that is really make sure in the Southern African region is that we deliver double-digit growth, is that we expand our offering in terms of channels, services in the Southern African region, and that will contribute positively both to revenue but also margin expansion. I think that just to remind the audience is that we did the acquisition of Roots, Akasi, and that is getting traction, and we're expanding market share there. In East Africa, we did that transaction of Tradco. We have the option to increase that by a further 20%. So we're going through the process of gathering information, and if the information we get is confirming what we think, we will in all likelihood execute on that option. And then I think the important thing is around expanding capabilities. I think that what external parties see is the tip of the iceberg, but I think we have invested an enormous amount around systems, processes, technology. And if one talks about the Botswana results, a significant contributing factor is our investment in inventory management, warehouse management, and transport management systems that really, I guess, aided our resource allocation in that market, which was all a building block to the success we had there. And our digitization journey continues. We're a far better business than we were a year ago. We know a lot more about our business today than we did a year ago, and that is an ongoing priority. I think it's probably worth talking about the acquisition. So we announced the acquisition in Q1 of this year of Sunpack, South African-based business. I've spoken a lot about the opportunity around private label, confined label, and brand owners looking for a end-to-end solution in these markets. Sunpack is a well-established business in the space. It's got scale. It's got a superb management team. It has a history of making profits. And so, we bought just over 70% of the business. Although the transaction is subject to regulatory approval, we believe it's going to make a meaningful difference to our South African portfolio and contribute positively to the group. I think just with regards to outlook, I think that, we really believe that there's continued demand for our offering in these emerging markets, particularly if we're a safe pair of hands, we're credible. I think that the investment in ongoing capability building, and I've mentioned this a few times around people, systems, and processes, is going to continue. And I think that we're always walking the tightrope to make sure that we are superb executors of brand strategies and that we're becoming increasingly efficient in the process. I'm going to leave it there, and I'm going to hand over to the floor for questions. So thank you very much, ladies and gentlemen.
Frans, thank you very much for coming back and joining us once again and Unlock the Stuff. It's been great to follow the C&S story since the spin out from the PSG days. I think you've been here since after your first results listing, so it's been good to follow along and get this latest update. I might just start with one question that South Africa was maybe the standout market in the result. And I'm just wondering if we could delve a little deeper into that, because we, hear lots of the retailers complaining, like gambling is impacting consumers, cost of living pressures, perennial comment from the retailers, fuel prices now, but yet, the South African business, both on the top line, the margin lines, is that coming from doing more with customers, getting more like higher value services with customers, and maybe just talk a bit more about how the South African market is growing at the rates that it is growing.
Yeah, so I think that, of course, the South African marketplace is tough. There's no GDP growth. Retailers are under pressure for margin, volumes, and it's a result of obviously consumers and shoppers being under pressure. But I think that we have a superb management team in our South African business. I think they continue to grow with existing clients, and so we've got very good organic growth out of our business. Our clients, if you onboarded some new clients in 2024, and in 2025 we rolled out more stores, so we're servicing an additional 3,500 stores that we didn't do for a client. So there's lots of organic growth as we become broaden our channel offering. More and more clients are coming on board. But I will say, Mark, my view is that whilst I'm delighted with the South African performance, I think the potential exists to do significantly more in this geography. If you think that we've got a 6 billion rand business in Botswana, albeit that it's a different offering in terms of walls, wheels, and distribution. I think the opportunity exists to do more in South Africa. And, I think that if you think about the Sunpack acquisition, you think about as we bed down new acquisitions and we close the gap on our competitor, bearing in mind our single biggest competitor, I would say, is probably twice the size of our South African business. There's still runway to grow market share, both with new and existing clients. So I'm saying is that I'm thrilled with the results, but I think the opportunity exists in both South Africa and Namibia to do significantly more.
Hi, Duncan. Frans, congrats on really, really good numbers. I think you certainly gave me a positive surprise with them, so well done. And I guess what I wanted to start with was just to understand some of the category trends at play, because you're in such different markets, obviously. And I mean, we were joking just before the call where I said I just got back from Egypt, and their government is trying to persuade people to have fewer children, whereas in most countries, the birth rate is actually a major concern. So you see that play out in areas like South Africa, where pet care is growing so quickly, whereas baby products maybe not doing so well. Elsewhere in Africa, where the birth rate is still high, you know, baby products probably a really good growth area. So the question is, because you operate across so many markets, to what extent are you actually tracking these trends and then going out and trying to find players in those categories? Or do you find that you can be more reactive? You have more than enough FMCG players coming to you, and you know, that kind of just comes out in the wash. You don't have to worry too much about which categories will grow next.
Yeah, look, I mean, I worry as a standard, so always worry. But I think that we're very mindful of trends, whether it's route to market trends or category trends, et cetera, et cetera. It's something we watch very, very closely. And if you look at the, you know, the what's happened in pet food and in terms of what the retailers have done recently in terms of banner stores, expanding their pet care offering in store, you know, I think that's just one example. But, you know, I think that if you look at our comparison between Eswatini and Botswana, in Botswana, you know, we sell tens of thousands of tons of rice in that market. In Eswatini, you know, we'll battle to sell 150 tons because it's a maize market. So, you know, there's market trends, but there's differences between the geographies. So we watch that as well. So making sure that we have a maize offering that's appropriate in Eswatini and a rice offering that's appropriate in Botswana to cater for different consumer needs.
We just talk about maybe the East Africa business for a second, and I just wanted, I know you talked about the potential growth in the South African market, but did we talk about the growth in this market? I mean, if we, you know, look out, you know, 3 to 5 years, I know the revenue I think was on that slide was around the 900 million. You know, could this be, you know, easily a 2 billion revenue market between organic growth, maybe, you know, a few more acquisitions in maybe smaller ones in various countries over the medium term? And is there any kind of different dynamics, you know, people should be aware of, you know, versus the Southern Africa business? You know, is there things, either routes to market or, you know, kind of product offerings, as the finance coach was just mentioning there, in that market that, you know, you wouldn't typically see in Namibia, Botswana, or South African context?
Yeah. So I think that, you know, my immediate response is that if one looks at the modern trade, general trade mix, I would say it's a 90-10 or a 85-15 at best. So, you know, I think that whilst we're getting a lot of expansion into formal stores and, you know, formal retailers, by far the dominant part of the market would be general trade. But, you know, I think that as we get urbanization, positive GDP growth, we'll see modern trade expanding rapidly, and we're seeing that already. You know, I think that if you look at a store in Nairobi, you know, I think there's a lot of very good local brands, very good local food brands, and you know, the consumer is very loyal to the brands that they've grown up with. So if you walked into a retail store, it'll feel familiar, but the brands might be a little bit different to what you see in the average South African store, particularly on the food side. Less so on personal care and home care. You know, I think there'll be a familiarity of brands and look and feel and offering around personal care and home care, and even I would say beverages specifically. I don't know if that's helpful or not, Mark.
No, it is, yeah, definitely. And then maybe just a quick follow on from that. I know it got a lot of fanfare at the time, but you know, the kind of African free trade agreement or whatever. I mean, how does that? I know it's a very slow moving thing with lots of bureaucracy, and lots of countries need to sign off and do various things. But in terms of, we think of CA&S operating across East Africa, Southern Africa, how does what's coming down the line with that agreement as these things eventually go into place? I know COVID destabilized a lot of the work that was kind of happening. How does that play into like your strategy? You kind of know, okay, in 2027, X tariffs are going to go down, or there's going to be it'll be easier to move stuff from, a DC in Joburg to, something in Nairobi or Lusaka, for example.
Look, speaking personally, I think that watch it, observe it, but don't count on it. I think that the single biggest opportunity for me in East Africa is infrastructure spend. So in other words, if governments get the infrastructure right in terms of rail, road, etc., that would be a catalyst to unlock enormous value, not only for our business, but for the economy in general. But I think that, you asked me a question around what does the medium term look like? I can tell you what we're planning to do. So if we've got a 12 billion rand business in Southern Africa, we believe that we can easily replicate that in East Africa. Of course, we don't want to wait 40 years to do it. It's going to require an enormous amount of energy, effort, investment, acquisitions, but certainly the potential exists. And I think that, the market is ripe for consolidation, formalization. And if you look at the conversations we're having, we think we can create something significant in that geography, particularly with the credible team that we have on the ground there.
Duncan, I've received an interesting question in the DMs that I'd like to deal with. So it's about the informal market in South Africa specifically. And I guess, you talk about the local trends. You gave us some very cool examples there. And this is a big one in South Africa, is that shift from informal into formal trading. But obviously, there's still a lot of trading in informal. So is that an area that you play in terms of brands trying to get to that market segment specifically? And any thoughts on that would be great.
Yeah, so if you look at our average client, they are tier one brand owners. And I would say without exception, they would be under-indexed in the main market. And so they're looking to us to see if we can provide credible solutions in that place, in that space. So, I think that one mustn't estimate how complex it is. You've got at least 140,000 doors to service, and it's very fluid. So, in geography A, you have a Somali store opening up. There's a community, unrest, aren't happy with it, closes down and something else opens up. So it's very fluid. But I think that, with the Roots acquisition, it's given us a very, very good insight into that market, a very good framework of which to build a robust solution. And we're doing lots of proof of concepts with existing clients around expanding into that market. So we have both a CASI sales, and we have Roots catering for different types of clients, but we expect that to grow considerably. But it's a tough nut to crack. It's a bit like eating a prickly pear. You've got to get through the hard, ugly stuff to get to the fruit. So we think it's the right long-term play. We think we are doing a lot of the right things, and we'll be rewarded for it over time.
And Duncan, I do want to touch on Botswana, given it's the biggest part of the group, and revenue did go backwards in the thing, but margins held up very nicely. Just maybe some comments on the revenue drop, is that from reduced volumes, clients what do I say, optimizing lines. So instead of having 3 products on the shelf, they cut down to the 2 best-selling ones. Just give us a sense of like what the brand owners, given where the Botswana economy is at the minute, like what are they thinking and doing and shifting their business to kind of respond to the the low diamond prices, which is impacting the whole broader economy there.
Yeah, of course, I think that there's no getting away from that. Botswana is facing challenges it previously didn't face. And obviously, I worry about pressure on consumers and shoppers, because that's ultimately what we rely on. I think that our expectation from Botswana hasn't changed. I look at market share very, very closely. And parking the revenue objective for a while is that my first priority is to maintain and grow market share. And I think that if we are credible, reliable, and stable and efficient, we will grow market share over this period. I also think that if you look at the clients we represent, I think that consumers see those as trusted brands, and I think we can benefit from that. There's no doubt that we've worked very, very hard since 2023 around mining efficiencies in that business. And we made massive investment in people, systems, and processes. And, just a crude example, Mark, is that if you look at third-party transport, we don't, not saying we don't, but we use third-party transport as an exception. We make our existing fleet work harder. By way of example, we load trucks at 4 o'clock in the morning, dispatch them at 6, and get them back to do an afternoon load. So we're making the existing resource work harder. And those are the tactical things we've got to do to make sure that we maintain and maintain the results. I think if you look at our clients, obviously I talk to our clients, the retailers, and you look at the two big listed operations, both of them grew revenue through this period, notwithstanding our contraction. So I think that, are we going to grow revenue in 2026? I think that we'll be disappointed if we don't. But, I think that we have a nimble, capable management team, and I'm fairly comfortable we'll get the right results.
Duncan, something else that I wanted to ask you, and I'm just listening to us talking about, again, the differences in these markets, and obviously CA&S building such a big African business at the end of the day. I think that's a big part of the investment case for you. And something I've always understood from you is when you do these kind of transactions, you're always looking for local partners. It's something I've always liked, is you do the bolt-on deals. You, generally speaking, keep the local partners involved for a while at least. And I'm listening to what you're saying about the local tastes and trends. And I guess that's the reason, right? Is because each country is actually just so different that you've got to go in with a local partner. And would you say that makes CA&S just much harder to copy as a group? I mean, that would be my take on it, is that's actually part of your moat. It's just how hard it is to go and build local capability across so many different markets.
Yeah, look, I think that the recipe of buying a minority stake in an existing business that is owner-operated and ramping that over a period of time, that recipe has worked for us, and therefore we have a bias towards it. I think that what I can say is that no two markets are the same. There are significant differences, and East Africa is no different. If you look at Tanzania, Uganda, and Kenya, there are similarities, but there are some distinct differences, and if one ignores that, you'll pay the price for it. So I think that my bias is always towards having local partners on the ground and having locals run the business. So in other words, Namibians for Namibia, Botswanans for Botswana, etc., etc.
I just want maybe maybe this one could be for Frans, maybe just on, if we look at the business, at the high level, margins have improved. There was a slide there, from like 2021, I think it is, up until today, and they're consistently improved. I'm just trying to get a sense, if we disaggregate that improvement in margin, is that coming from, you've mentioned it a few times, investments in people, processes, systems. Is it coming from that? Or is it more coming from, higher margin offerings being taken up by like more clients, or some kind of maybe combination of the two?
Mark, I think all of those things is Duncan always have a saying that says, you plant the acorns today for the future. So all of these things is a contribution of what happened in the past, and that we're now starting to see the effect of that. But I mean, give the guys from Botswana a lot of credit. They mined a lot of efficiencies, as Duncan said, with the transport management, and also the mix of products has also changed. So and doing things differently from what we always have done also contributed to a better margin. Simple thing like damages. I mean, we're giving a swell allowance where we previously managed the swell allowance. The benefits of that is much bigger to give the swell allowance to the retailers. So a lot of things added to the contribution of the margin increases in the group, and hopefully all of this will carry forward going forward as well.
Duncan, Frans, I'm not sure which one of you would want to take this question, but we'll see. So obviously we've seen a serious improvement in sentiment in Africa in the past year or so. I mean, the currencies are doing much better. Things are growing. It's a completely different world to what it was, say, 2 years ago. And I would guess that with better sentiment comes pressure on deal pricing. So I was wondering, when you're looking at these bolt-on deals and you're considering things in the market, what are you seeing in terms of, firstly, deal flow, sort of accelerating, decelerating, flat? And then pricing expectations of the sellers. Are they coming to you and saying, hey, Africa is cooking, come and pay us big money now? Or do you think there's still value there?
You know, I think that good businesses are hard to come by, and good businesses are generally fairly expensive. But I think that what we try to do, you know, I think if one uses our Tradco acquisition as an example, it's to find the right operator who has an aligned long-term objective. And, you know, I think that if we are able to align on those two things, the price discussion becomes a lot easier, because the individuals around the table are, I guess, vested in the longer term growth rather than, you know, what's in it for me now. So of course, you know, one always wants to walk a tightrope, but ultimately you want it to be fair, because, you know, in this process you want to maintain goodwill, you want to grow goodwill, because the relationships with the people around the table is the glue that holds it together. So, you know, I think that we have a very clear framework of what we will pay for businesses, and if we can't land it at the right price, we're very happy to walk away. You know, I think that we're very focused on growing revenue, but we are certainly not going to overpay to grow revenue. So I think that we're probably fairly conservative in that respect, but I think ultimately if you find the right business with the right partner, you will find alignment around pricing.
Maybe if I can just ask a quick follow-on around that, just from a regulatory perspective. I mean, you mentioned that the local deal is subject to the normal sort of regulatory approvals. Slightly difficult question, and obviously there's only so much you can say on it, but in terms of market share and how you guys define your market, I mean, my sense is this market is absolutely enormous. I would imagine that CA&S is still a relatively tiny percentage of the activity in the space, actually. So would it be fair to say that in terms of running out of steam on deals, bumping your head against competition regulators or anything like that, I would imagine your runway still looks good? Would that be a fair statement around how many more deals you can do over the next 3-5 years?
Yeah, so I think that the short answer of yes, I think that, you know, if one looks at consumer goods, we're, you know, I think we make a small part, make up a small part of that ecosystem. You know, I think in terms of market share, I'm not sure, but we'll be, you know, fairly small or, you know, close to insignificant in that space. I think that in terms of runway to grow, you know, so as we expand services, as we broaden channels, I think that there is lots of runway. You know, even in a marketplace like Botswana, there's opportunities to grow. I think you heard me talk about specifically South Africa and Namibia. I think those are our two single biggest revenue growth opportunities in Southern Africa, and of course East Africa speaks for itself.
Okay. Duncan, Frans, I don't have any further questions on my DM, so we might just wrap it up there. Thank you very much for joining us, and I'll hand back to Vanessa to see us out.
Thanks, Mark. Thank you to everyone who chose to join us today, but a special thank you has to go to Duncan, Frans, and their investor relations team for making time to support our platform and to engage with the retail investors. So thank you very much, Duncan, as always, and Frans. Our next session takes place on Thursday, the 16th of April, and that's with Keyter. So sorry, Duncan, I interrupted you there.
No, I just wanted to say a massive thank you to you and the team. Always delighted to be here, so thank you.
Oh, it's a pleasure. And thank you for making the time. I know you have a busy schedule, so thank you. That is all from my side. I'm going to say goodbye until the 16th of April, next Thursday. Thank you, everyone. Goodbye.